Hello and welcome to the ASB Investment Podcast, the show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that will be happy to chat if you need. Well, hi, and welcome back to another edition of the ASB Investment Podcast. Today we're unpacking the RBNZ's latest OCR decision, announced on February 18. It was the first one for the new RBNZ Governor, Dr. Anna Bremen, along with a monetary policy statement. Now, the OCR was previously sitting at 2.25%. Today, the Reserve Bank has decided to keep things on hold, which results in an OCR still at 2.25%. There's always a lot riding on this, though. There's investment decisions, mortgage rates, the housing market and the broader economy, not to mention what impact it could have on inflation. So to help break it all down, I'm joined by a familiar voice. He's back. I think he's back for his, maybe his second one. First one, second one. Who knows? Senior Economist, CTB, Chris Tennent-Brown, welcome back.
Thanks, Nigel. It's good to be back.
And you always have interesting stories. What have you been up to since the last time you were on?
Actually had a fantastic time catching up with some very dear old friends that I met at primary school.
Gosh.
Which was 50 years ago. We had a couple fly over from Aussie and a few that still live in Auckland and some really lovely get-togethers. So it was a nice mini holiday for me with catching up with some old friends, and we did some fun stuff like go for a motorbike ride. We had a few barbecues and told some tall stories. So I had a fantastic week last week. That's probably the highlight for me of since we last did a podcast.
And are you still pulling up potatoes?
Oh no, the potatoes are all pulled up. I've got them stored as you do, somewhere cool, somewhere dark. So that was my contribution to at least one of the dinners. Was I provided potatoes galore.
Oh,
but nearly finished now.
As well, you are a potato farmer.
Oh, there was a lot of potatoes this year.
So let's start with the big headline, CTB. The RBNZ Reserve Bank has obviously decided to keep things basically where they are. Simply put, were you surprised?
No, we weren't surprised. I think the thing for markets over the past 3 months or so has been the change in position and commentary from the RBNZ back in November. Actually, statements and the comments were more along the lines of perhaps what we would have expected in November. And to use the jargon, we sort of talk about the RBNZ's attitude being either hawkish or dovish. What we're referring to is their attitude towards inflation and how concerned that they are about it. And yesterday's meeting was relatively dovish, with the Reserve Bank not sounding like they were in a hurry to raise the official cash rate, but certainly not sounding like they had any plans of cutting it, which was the expectation that many had late last year, that would still be seeing rate cuts this year. So, yeah, a dovish statement, but not as surprising as perhaps the commentary in last November was.
And I guess that's a key part of the language from the statement. Was there anything else that stood out to you? Have they signalled anything? Or, have they been a bit more overt in their signalling of things, or have they mentioned any other risks that kind of were not on people's minds?
Oh, well, one thing that's interesting and that I think is a really good decision is the Reserve Bank governor mentioned that they'll be moving back to holding 8 meetings per year. One of the
Everyone loves more meetings.
Oh, that's right.
Or is that less meetings?
No, that's more meetings. So they unusually dropped the January meeting. So the RBNZ went from holding 8 meetings per year, basically one every 6 weeks, to only holding 7. And as a consequence, we got this big gap over Christmas for the last few years. This year was a case in point where an awful lot's changed between the November meeting and now for markets to digest, and a move back to having 8 meetings per year, I think is a good one to shorten up the period between the last meeting of the year and the first meeting of the following year.
Well, I mean, yeah, we love more meetings, especially coming back everyone loves a January meeting, and I'm sure all parties would relish that. Do you think? I guess we're always in a cycle of some sorts, where we are in that cycle as opposed to the start of one, but are we closer to the start of a different part of the interest rate cycle? Are we closer to the beginning or the end of I'm not sure where we're going, but you know what I mean. Where are we at?
I think this highlights the key point is that the official cash rate announcement in itself is not necessarily the start or the finish of a cycle, but the expectations of what the Reserve Bank's going to be doing over the year and years ahead clearly does influence the cycle for things like mortgage rates, which of course have been on the rise of late, despite the fact that the Reserve Bank's kept the official cash rate at its on hold setting. So I think we're at the clearly at the end of the easing cycle. The next move is going to be up for the official cash rate, and that's already getting priced into interest rate markets that customers care about, the term deposit rates, the business borrowing rates, and household borrowing rates.
And before we get to, I guess that we always go to mortgages as the, sort of the natural flow on first point, but even though it was a hold, did anything move off the back of it? You know, yields overall, the currency, did anything budge, or was it kind of all still on the water across the board?
On the day, that slightly more dovish outlook from the RBNZ that I mentioned did see wholesale interest rates or swap rates, as we talk about, decline. And we saw the New Zealand dollar weaken by over 0.5% against the US dollar and the Aussie dollar as well. So we did see a reaction in financial markets, but the reaction for retail rates, so term deposits and mortgage rates, the big moves had already happened over the preceding couple of months. So we've seen longer term mortgage rates lift in advance of this meeting. And likewise, longer term deposit rates also rose over the earlier parts of this year. So no reaction in those rates that I've seen in the subsequent 24 hours, but a lot of movement in advance of this meeting.
Yeah, well, I guess markets will always move probably before the ultimate decision, I guess is what you're saying. Let's talk mortgages, because that's, it flows through to a lot of listeners and where they're at in their stage of life. What does this decision mean for actual mortgage rates? Does it mean anything that we already weren't already assuming, or has it kind of kicked the can down the road a little bit?
The message is essentially the same as what we were talking about in earlier podcasts, is that the low point in mortgage rates is probably behind us. And so, of course, if the economy changes and takes a turn for the worst, the Reserve Bank will respond. But their projections, market expectations, our forecasts are all consistent with the official cash rate being at the bottom now and needing to start to lift over the course of this year and next. So that's what's already feeding into the rates that impact 2 years to 5 year mortgages and those longer term deposit rates as well.
I guess it's, as we've always said over the last few years, I guess you're trying to pick a bottom. It's often very hard. But I guess is it fair if you think things will go even lower and you're hoping to anchor your decisions on that, you're almost wishing perversely for the economy to do worse than it already is, which is kind of like we almost don't want that. So you kind of want to see a bit of interest rate movement upwards, because that's when the recovery is probably getting better, right?
Yeah, that's right. I think a classic example, I run in a spreadsheet where I can look at what rates will people have mortgages maturing at this week. We've got mortgages maturing where people, say, fixed for 5 years ago during COVID,
yes,
that are rolling off very, very low rates. Some borrowers go, hey, what will it take to get interest rates back down to those 2 to 3% levels we saw in the past? And the answer is, well, I'm wishing we never get back there, because that would probably mean we had another pandemic or a global financial crisis. Whereas what we're talking about is a grinding economic recovery, which is allowing rates to be at still historically low levels, but not at the all-time lows we saw in the past. So, yeah, be careful what you wish for, I think, when it comes to wishing for low rates, because we're already dealing with an economy that's grinding out of a bit of a hole it was in the middle of last year. I don't think anyone wants us to go back to that weakness that we saw, let alone the situations which drive mortgage rates down to the all-time lows that we saw during the pandemic.
I love a good spreadsheet, as my colleagues know. So you talking about a spreadsheet that charts all of those things. On that spreadsheet, the last question I had before we get to kind of housing, I guess, the housing price implications, is I thought everyone was already off those higher rates at the second part of kind of the pandemic period to squash inflation. Is that not the case? And there's still some rolling off low onto what would be higher for them?
Yeah, so most people in the mortgage space like being in that floating through to 2-year part of the curve, and that strategy's worked pretty well. Often the cheapest rates are the 1 year or maybe the 2-year rate. And there's not a lot of people that fixed for the low rates in the pandemic, that 5-year at 2.99, but there still are some people that have got that. Most other people are into their second or third or fourth rollover from COVID, because a lot of people have just gone back to that habit of fixing for 1 or 2 years. And over the past year, we saw an even greater intensity of people floating or fixing for very short terms, because they did want to try and pick that bottom in rates. And as long-term listeners and readers of my reports will know, I've always encouraged people to get on with it and make sure they're trying to lower their interest rate expense over the entire period of a life, rather than just get, say, a low rate, but potentially pay a higher floating or 6-month rate in order to get it. That's no change in the thinking there. But while we're on it, if we look at that sort of profile, someone that had fixed a year ago or 6 months ago or 2 years ago is going to be rolling into lower rates when their mortgage does mature. There's still some stimulus to come through from people getting onto lower rates, even though the rates themselves have lifted off the low point.
Yeah, there was an interview on the news. Yes, I still watch the 6 p.m. news. You can see it, get an insight into my life. But with a florist who was talking about how they were interviewing her, how was Valentine's Day this year, and it was tough. I think she was saying some people buying, she made a really good point. Like, if you're still dealing with a mortgage rate and the cost of living, insurance, and those things, you are going to have to compromise. So I thought hopefully we do see some relief coming through in that. So CTB, I wanted to just move on to housing. What does the hold mean in the immediacy for house prices? Is it just sort of a status quo? We see things sort of grinding away, or is anything in the statement they said yesterday that the governor said gonna impact housing, I guess, too much?
No, not really. I guess it's really just a continuation of that same thing. The surprise for many investors that are interested in the property market and people looking to sell was just how flat the housing market was last year, and really didn't respond to low interest rates like we would have expected. That environment's going to carry on this year. I think rates are still low and supportive, but some other dynamics are still weighing over the housing market. And one factor is that some people that bought during the pandemic will still be looking at a house price that's below what they paid.
Yeah,
that
tough.
Contributes to inertia in the market. And we've also seen a massive change around in migration inflows from very, very strong levels a few years ago, which supported the housing market and supported rents, to a very flat migration outlook. We're probably past the worst or past the low point, but we're still talking 10, 15,000 population growth coming through via that net migration flow, in contrast to well north of 100,000 a few years ago. So quite a change in demand for housing that's still a bit of a hangover. So a feature of the Reserve Bank's commentary and economists, including ourselves, of late has been really toning down the expectations for a pickup in the housing market over the course of this year. Interest rates are just one factor of it. The fact that the Reserve Bank expects to be on hold for a reasonable period of time, most of this year based on their forecasts, but expect inflation to cool down somewhat, is a helpful interest rate backdrop.
Certainty.
But when the facts change, the Reserve Bank can change their mind as well. They could end up needing to hike earlier and by more than they're currently forecasting. But for now, what it looks like for the housing market to me is a supportive interest rate outlook, but some headwinds coming from the other key drivers for the housing market, and hence that view that we should have somewhat subdued expectations for house prices over the year ahead.
I think a future episode we could probably be worthwhile deep diving into kind of that. We talk about different cycles, but that cycling through housing stock of different generations and life stages is quite an important thing. If houses aren't being released to the kind of, the family of four is in a too small a house that in other cycles they probably would have been able to recycle through, and kind of how that can stagnate the economy a little bit. It's probably not talked about enough, probably.
Yeah, I think the thing for New Zealanders too is we get a lot of our confidence from housing. For most people, it's their biggest financial decision, and it's also for homeowners often their biggest financial asset. So the housing cycle is really important for things like consumer confidence. Whereas if we were looking at other economies in the world, it would be share market performance that was more of an influencer on consumer confidence. So it's a really important part of our economy. Yeah, wealth effect is what we tend to call it.
Okay, turning to the other side of, I guess, an investor or a general person in the economy, their balance sheet, savings and investments. What implications do you think there are following the decision for users of term deposits, for instance? We know that's often a neglected part. We talk about mortgages a lot. We've been doing a lot of events and conversations with clients around the country, CTB, and there's often conversations about what do I do with term deposits or investments. Are there any implications from yesterday for customers who are in that sort of neck of the woods?
It's a bit like the mortgages. The longer term rates have moved in advance of what the Reserve Bank's been signalling. So, for example, we've seen 5-year term deposits move from 4 up to 4.5%. Or thereabouts, whereas at last year we were seeing the 1-year term deposit rate steadily falling as the Reserve Bank delivered that last part of the easing cycle. So I think the good news for term deposit investors is that we're past the lows for term deposits and they have picked up somewhat. The problem is always, are you keeping pace with inflation? So is your after-tax, after-inflation return a good one? Now, a lot hinges on whether the Reserve Bank's right that inflation will fall back to around its 2% goal over the course of this year and next. If it does, and term deposit rates stay around that 4% mark for the longer terms, then that's a positive environment for term deposits. For the share market, it's a little bit like the housing market. Most businesses are borrowers too, so the lower interest rate environment is the one that they want. Now, our share market had a pretty rough start to the week, but responded very positively yesterday to that slightly more dovish, as we say, or cautious approach to the upcoming tightening cycle. And so we saw a decent gain for the share market. And we've got some very interest rate sensitive stocks. Some of the utilities really are an income play. So the view is that there'll still be interest in those companies because of their high dividend if it's not going to get trumped by raising term deposits over the course of this year. So I think that's a pretty logical conclusion. I don't think the longer term deposit rates are going to go up much from here, if at all. It'll be movements in the shorter term deposits as the RBNZ gets closer and then into their tightening cycle, which we're thinking is late this year and over the course of 2027.
And I guess to go back to that other comment about, be careful what you wish for. I guess if you're a term deposit investor and you're wishing for the days of 6 or 5.5%, 6%, you got to think, well, that might be good for me, but why is that happening? Conceivably, if they're that high, someone's trying to squash rampant inflation.
That's right. I mean, in a nominal sense, during the tail end of COVID, before the official cash rate had really started getting
turned up.
Yeah, we saw term deposit rates during that tightening cycle get to over 6%, which sounds great, except when you think that over the course of that term deposit's life, we had inflation getting as high as 7%. So to your point, be careful what you wish for. The time when the nominal term deposit rate was higher, it was all getting gobbled up by inflation in many instances. Now, even though those nominal rates are lower, we do have an environment where we think hey, for 2 years and beyond, term deposit rates are above where we expect inflation will be tracking. And that wasn't the case a few years ago. We were forecasting inflation to erode all the returns of term deposits.
And I guess, what you're looking for potentially is that Goldilocks porridge interest rate bowl, right? Not too hot, not too cool. You just want it in the middle. Let's zoom out a little bit, CTB, before we wrap up. Is there anything in today's or sort of this week's decision that tells us broadly about what's happening, or I guess broader about the New Zealand economy? Is there anything that stood out? I guess what should households or businesses be looking at next?
I think the main message for me on the economy, and this includes some of the RBNZ's views on the outlook as well, is that it does feel like we've turned a corner and we're moving away from that soft patch that we endured last year. The question is, how quickly will inflation start to cool? Because inflation looked like it was past its worst and had got down to just north of 2%, so essentially back on target for the RBNZ. Now it's crept up to over 3% by the end of last year, and it's outside the top of the target range for the RBNZ. So I think for households, as boring as it seems, keeping an eye on inflation is really important. Firstly, for our budgets, there's still a lot of cost pressure out there for households, but it's also really important for the outlook for interest rates. If inflation fails to cool along the RBNZ's lines, they might need to raise interest rates sooner or more aggressive than what they forecast this week. So, watching inflation. At the end of the day, that's the Reserve Bank's goal and the reason why they set interest rates. So inflation developments will be really important over the course of this year.
And just to summarize, I guess, we obviously, if you're just listening to the end of the podcast and you skip the rest of it, the Reserve Bank has held the OCR at its current. CTB, I'm going to go to you just for some rapid fire kind of couple of word answers to each of these. So mortgage rates are likely to what?
Be past their lows, and we should still see some more increases over the course of this year.
Okay. TD rates are likely to insert words.
Term deposit rates are also expected to be past their lows. The longer term rates have lifted a lot already. Over the course of the next couple of years, we'll hopefully see some of those shorter term rates that are very popular with savers, the 6 month through to 18-month rates start to lift as well. But that might be a wee way off and heavily influenced by when the Reserve Bank actually does start lifting the official cash rate.
Well, that was more than a few words for that one. Investment markets. If we thought the local investment market, or the NZX, for lack of a better example, is likely to what?
I think be supported by the Reserve Bank's patience as the first comment. Heavily influenced by the economic outlook as well. So again, any news that the economy is starting to turn a corner and perform better will be well received by the share market.
Housing sentiment may do what?
Gradually improve, but remain lackluster, I think, over the course of this year due to those headwinds we've discussed.
I think that's a theme for another episode. Sort of, I've sensed this, is there a changing perception of that kind of, before it was just maybe just buy a house and it would go up in significant value. I think that's an episode for a different time in terms of what, investors should be thinking about. The final one of these, the broader economy will do...
Continue to recover is my hope and our forecasts.
Great. And so to the final question, CTB, one we've done many times, for a recommendation on what you're reading, watching, listening to. What is it this week?
Well, I've got something very exciting. I'm going to the... military tattoo tomorrow at Eden Park.
Is it? Gosh, that's come round already.
Yeah, I'm so excited. Now, my mum wanted to take me when I was a kid and it got rained out. I've been waiting for this opportunity for 50 years.
Oh, do you have a family tartan?
We do, the Anderson tartan.
Oh, Anderson tartan. And you're not of the, I should just flat out ask, you do or don't wear a kilt?
No, I've restricted myself to, I've got an Anderson tartan scarf, but I always quite fancied a kilt, but no, I've stuck to the scarf.
Yeah,
at this stage.
I could see you on Arthur's seat in Edinburgh with bagpipes. I could see that. Quite a good bit. So I'm
looking forward to some bagpipes. Yeah. So what about you? What have you been up to? I didn't ask you what you've been up to at the start and what you've been reading. So we can do both those now.
Well. I feel particularly or equally culturally literate by my recommendation, which was I am committing to the Married at First Sight season, the latest one. And this is not like, usually it's kind of like, I can't be bothered with that, and my beautiful wife will watch it, and then the next image is me standing up in the lounge going, I can't believe he did that or said that. I am fully in on this season, and I'm going to watch all the episodes. So I just thought,
Excellent.
Edinburgh military tattoo, maths, we're very cultured podcasters, aren't we?
We'll have to do a deep dive onto that, as well as the housing market, in a future recording.
I mean, if you were going to use a market analogy, my gosh, it's volatile. There is the VIX, the maths VIX is all over the place. And no, I haven't been up to too much. Just I trimmed all the hydrangeas the other weekend. One thing, I'd just sort of de-headed those flowers, getting ready for the winter. And my wonderful wife did a massive walk around the King Country on the weekends. I was very proud of her for doing that, but it was quite, I think 24 Ks or something. So I've sort of been hunkering down while she was off doing that. CTB, thank you for giving up your precious time. I know you're a little bit under the weather as well, but it's a pleasure as always having you on the show, and we look forward to seeing you in the skies sometime soon. Hope you had a good time.
It's been great being here. Thanks for having me.
So until next time, keep your eyes on the skies for your favourite senior economist, CTB, but also keep an eye on your interest rate risk. As CTB always says, have a plan and don't try and wait to pick the bottom or the top. It's better to have a plan and kind of just get on with things. That's not advice, but it's something we always try to encourage people to consider when they're making decisions. So with that, happy investing, and bye for now. Thanks for listening to the ASB Investment Podcast. If you have any thoughts on this episode, or if there's anything you'd like us to discuss on a future show, get in touch with us at podcasts@asb.co.nz.